Welcome to ForexTV.com's PM Exchange. It's Friday, January 4th. I'm Remy Hokie. Today I'm joined by Michael Woolfolk from the Bank of New York Mellon. Good afternoon, Michael.
Hi, Remy. How are you?
Good to have you on the show today.
Yes, and thank you for inviting me.
Well, in today's session, we started out from with the employment situation report from the Labor Department, and we got quite a surprise in both the non-farm payrolls number as well as the unemployment. But given that there are concerns about a slowdown in global growth, for Forex traders out there, what fundamentals and factors of the global economy should they be paying attention to?
Well, Remy, you mentioned today's non-farm payrolls. That's kind of considered informally as kind of the granddaddy of all U.S. economic releases. One of the most difficult to predict, for one thing, and also one of the most important in terms of judging the health of the labor market, jobs growth. Unfortunately, it came in well below expectations, 18,000. Expectations were considerably higher at 50,000, 50 to 70,000. We had some modest historical revisions, but did not take any way to the negative tone of the report, particularly given the fact that the unemployment rate rose considerably. If you take a look at the unemployment rate, it rose to 5% from 4.7%, where 4.8% was expected. I think that there was some headline shock, just sticker shock, from seeing a 5% handle again on the unemployment rate, and that's going to be, I think, an issue going forward, really, because it does reflect some ongoing and persistent weakness. It may also keep the door open for the Fed to continue cutting interest rates this year. What should the foreign exchange trader be focusing on more globally? I'm a little concerned about $100 a barrel crude oil prices. I realize we've slipped off that a little bit, but I would watch commodity prices. At this point, they are contributing to inflation, headline inflation, not only in the States but abroad, and will ultimately need to be addressed by higher interest rates. I think that's one of the things that has the ECB quite concerned right now. Trichet indicating he has only one needle on his compass. He's not going to participate in any global round of easing because of that. I think also you have to watch very closely the performance of equity markets. I think that that's a good barometer for the risk tolerance of international global funds, and they're willing to invest in emerging markets as well as in overseas equities, and that will determine the degree to which you're going to see continued participation in the yen carry trade. That will not only determine the value of the yen, but also to a lesser degree the value of the Aussie and Kiwi currencies, which are some of the primary beneficiaries of that carry trade. And I also think that you have to watch very closely U.S. Inflation data coming up later this month as an indicator of what the Fed is likely to do. And don't forget that just in general, the U.S. is slowing, may get down to 1% growth for the fourth quarter, but really we have strong growth in China and India, which continue to help drive the economy forward, with the other G7s participating about 2% growth each.
Well, Michael, as you mentioned, we saw equities react to today's non-farm payrolls data, and also the surprising rise in unemployment. But even before the New York session, we saw the Nikkei end down over 600 points for the first trading day in 2008. And as we saw the yen rally continue in today's session, going forward into the weekend and into next week, if you could give us your take on the recent yen rally.
Well, Remy, this was the first trading day of the new year in Japan, and this was a reaction, I think, a delayed reaction to the sell-off seen in the U.S. equity market as well as markets overseas. I think it was highly anticipated, although still unwelcome, because such a significant drop in the Nikkei obviously is negative for the yen carry trade, because it suggests risk in equity space and it pushed dollar yen temporarily below the 108 level overnight. So we're really looking over the course of maybe the next week for dollar yen to trade between about 107 and 111. It's a large, broad range. We think that equities are likely to respond favorably beginning next week. Over the next 2 weeks, you're going to see this kind of January effect in global fund management community with fresh annual allocation of funds, and it tends to have not only a positive effect on equity prices, but it also has a positive effect on the U.S. dollar. The U.S. equity market is a very large, disproportionate in terms of its size of the total equities outstanding globally. And similarly, the U.S. bond market is disproportionately large compared to other countries. So I think when you're diversifying or investing in a diverse portfolio, the dollar does get a temporary disproportionate benefit when foreigners invest in dollar-denominated securities. That tends to, as we've seen over the last 4 or 5 years, fade away by the end of the third week of January. We come up to I think the January 31st decision of the Fed, in anticipation of the Fed rate cut, then the dollar is going to resume its weakening.
Well, Michael, you mentioned the January effect and the Fed meeting at the end of this month, but looking ahead to next week, we have both the ECB and BoE meeting. So if we could discuss rate differentials and how this translates into action for euro dollar as well as sterling dollar, and if you could give us your forecast for those currency pairs.
Well, as your viewers are undoubtedly aware of, I mean, it's really interest rate differentials and expectations of changes in interest rate differentials in the future that have a very important effect on foreign exchange prices. And given that the market is anticipating a Fed rate cut at the end of this month, we would really need to see the ECB and the Bank of England follow through with similar rate cuts in order to keep interest rate differentials constant. We have not built in any expectation of an ECB rate cut. To the contrary, their next move is probably going to be a rate hike, and I think an unexpected rate hike maybe in February or March could push us over the 150 level in the euro dollar. But expect nothing from the ECB except perhaps further warning of an imminent rate hike to come because of threats to price stability. You're going to mention money supply, M3, as well as harmonized inflation throughout the Eurozone. The Bank of England, look, the last month's worth of data, Remy, has been weak in the UK. Housing has been a grave disappointment. It appears as if the fundamental drivers of the economy, as well as confidence, is declining. So we would not at all be surprised to see another rate cut by the Bank of England next week, although we only attribute about a 50% probability of that, and probably wait just as likely to wait till the next meeting before we get a 25 basis point cut. If they do cut, you could see 195 in cable pretty quickly. And we think that one of the biggest movers this year in the majors is going to be the euro-sterling cross.
And indeed, in today's session, we saw another record high for euro sterling.
Yeah.
But before we wrap up today's interview, if we could touch on the so-called commodity currencies,
Sure.
The Canadian dollar as well as the Aussie against the dollar. This week, we saw a rally in commodities, record highs for crude oil, as you mentioned earlier, and also a surge in gold prices. But given that we saw dollar CAD go back above parity briefly, and Aussie dollar, we saw a sharp slide in Aussie yen, and then this also added to selling pressure for Aussie against the dollar. But for these commodity currencies of the Aussie and the CAD, if you could give us your outlook going forward.
Well, sure. We had a very unusual development in trading in North America this morning with respect to the Canadian dollar. Although most attention was focused south of the border on U.S. data with the employment report, non-farm payrolls, and unemployment, as well as the 10 o'clock release of ISM non-manufacturing. A lesser-known Canadian statistic, monthly statistic, the Ivy survey for purchasing managers, came out considerably weaker than expected, and the market sold the loonie on that strongly enough to suggest that the market really is searching for a reason to short the loon right now, and not a particularly strong technical development. So there could be further downside potential for the Canadian dollar. But nonetheless, we do think that the outlook for the Canadian dollar remains favorable given elevated commodity prices. We're going to put the range for next week for dollar Canada at a low of 99 cents and a high of 1.01. In terms of the Aussie, it has had historically a relationship with gold prices. So hence the recent highs in gold, I think, speak favorably for Aussie. However, Aussie is being, I think, handicapped, limited in terms of its upside potential, as well as, to a lesser degree, Kiwi, by players at the margin taking off these yen carry trades. So it strengthens the yen and negatively impacts Aussie and Kiwi. So I think that we're definitely going to, with respect to the Aussie dollar, remain below the 90 cents level, and we're going to see a trading range of about 86.50 to maybe 89.50. Those are big, wide ranges, but I think one of the certainties in 2008 is continued elevated volatility for foreign exchange prices.
Okay, Michael, as always, thank you for coming on the show, and have a Happy New Year this year.
And Happy New Year to you too, Remy.
Thank you.
Thank you.
This has been your Forex News with Michael Woolfolk from the Bank of New York Mellon. Next up, we have your equities and commodities wrap-up for the day. In today's session, U.S. stocks took a nosedive with the major indexes tumbling on the weaker-than-expected non-farm payrolls report. The tech sector took a hit on the downgrade of Intel Core. Taking a look at the U.S. jobs report, the Labor Department said U.S. non-farm payrolls rose by only 18,000. The figure was sharply below forecasts. The Labor Department reports show that employers added the fewest jobs to their payrolls in over 4 years. Yet, NFP for November was upwardly revised to 115,000 and downwardly revised to 159,000 in October. Meanwhile, the unemployment rate rose to 5% from 4.7%, and average hourly earnings rose 3.7% year over year. And the ISM's non-manufacturing index fell to 53.9 in December, which was better than the consensus forecast. At the closing bell, the Dow Jones Industrial Average fell almost 2%, or 256.54, closing at 12,800.18. The tech-heavy NASDAQ tumbled 3.77%, or 98 points, to 2,504.65. And the S&P 500 fell 35.53 to close down at 1,411.63. Taking a look at the fixed income market, U.S. Treasury bonds climbed in today's session following the weak employment report. Treasuries gained as recession fears continue to weigh on investor concerns. The bond market closed out the first week of 2008 with gains. Meanwhile, the benchmark yield fell to a 6-week low. The benchmark 10-year Treasury note gained with its yield at 3.86%, down from 3.89% late Thursday. The 30-year long bond rose with its yield at 4.36%, down from 4.37% late yesterday. The 2-year note rose with its yield at 2.75%. And taking a look at energy, crude oil futures declined after hitting record highs in the previous 2 sessions. The latest NFP and unemployment data increased concerns about a slowdown in energy demand. By the end of the session, February crude ended down by $1.27 at $97.91 a barrel on the NYMEX. In other petroleum products, February heating oil fell 3.56 cents to settle at $2.6835 a gallon. NYMEX February RBOB gas futures ended down 3.04 cents at $2.0511 a gallon. Earlier today, the EIA reported that nat gas supplies in the U.S. fell by 87 BCF in the latest week. On the NYMEX, February nat gas futures added 16.7 cents, closing out the session at $7.841 per million BCF. And in metals, gold futures ended the session lower, while trading was choppy on the day. This came as some investors moved in to take profits. February gold settled down by $3.40 at $865.70 an ounce. And taking a look at other metals, March silver shed 3.8 cents to close at $15.462 an ounce. March copper fell 3.05 cents to end at $3.1575 a pound. This afternoon, we're joined by Tom Puckett, commodity broker at KS Futures. He'll recap this week's action in energy and metals and also give us his outlook for the upcoming week.
As we close the Friday trade on a short week, New Year's week, we've seen some record trading in both the crude oil as well as some higher prices in the gold. A lot of energy information, a lot of news headlines affecting all the markets. To look at the gold first, we have today traded in the 871.8 down to 857 on the February contract in the futures. Actually down about $4 an ounce, but still in a high range. Very definitely, we have some strong support in the $855 per ounce price range. And we need to watch to see what happens on those things. The next support lines will be down between about 835 and about 830. So may see some profit taking come in here in the near future, but the look right now on the metals is that basically they're in a bull mode, and it looks like they're going to keep their value, what with the international events, Pakistan, election turmoil in the news here, and things going on. A lot of things are causing the haven of gold to look attractive to a lot of people. Plus, from the speculative side, if a market's rising, a lot of people just try to get on and ride it to higher prices. Silver is also down today, although during the week we've traded in strong range. The March contract around 1540, 1550 range. And though we're down a little bit still, it's in high price range, and we have some strong support between about 1525 up to about 1550. So we're just right there at that support band, and where we go from here will be anybody's guess. If profit taking comes in, I would expect it to be mainly selling rallies and buying dips with again a positive look on it. Another thing driving this, of course, is the currency discussion that goes on between the dollar index and the euro currency index. Dollar is back in the 76.76 cents range, with the euro at about 147, 148. And they've been running antithetical for some time. The euro's up, usually the dollar's down. The dollar's up, the euro's down. That has maintained and remains a very interesting trade. What the dollar may do in the future, don't really know, although that does make U.S. goods look attractive. It actually may work out to where the euro has not got the attractiveness because of the exchange ratios. The Dow Jones is trading down a little bit today, as is the S&P. Doesn't necessarily indicate a change in the market's strength. I think the markets remain very strong. But again, we're looking for markets that move up and down, and so we see a lot of people entering, as well as funds buying and selling in these markets. On the side of the crude oil, we hit $100 this week on the price of a barrel of crude oil, and we've had a little sell-off. We're right now in the February contract. We're looking at about $97.85, $98 per barrel. Again, strong support in the 93.80, 93.70 range, with another little support line at about 94.55. What will happen there, again, is anybody's guess. Although we've had some news that's come in that has proved to be kind of interesting. OPEC did have a higher output in the month of December, and they're going to discuss next month whether they're going to officially increase production again, which may actually serve to press prices down. Inventory report came out with a much larger decline on the crude oil. We were down by 4 million barrels, whereas the expectation had been 1.7 million, so it was strongly lower. Distillates, that's the heating oil and the diesel, were actually up slightly, about 600,000 barrels, but not a significant move there. The high price of oil at $100, anytime you see big round numbers, there tends to be a reaction in the market, and this may be part of the sell-off we've had, a couple of dollars off of that. Could go higher. At the same time, the higher it goes, the more the tendency to want to take profit may move in. Gold also was up a little bit in relation to the jobs data that came in. So, again, a lot of things going on in the economy. I think these markets will continue to be strong. I actually look for higher prices in the metals. I'm not so sure that the crude oil and the correlative markets are going to go higher just because other things may. Natural gas is trading in about 780, 770 range. It's come off some highs. We're getting some cold weather now. We may see a rise in that. And so the gas market and the crude oil market are of great interest to the consumer. A lot of fund interest in those markets. When funds tend to enter a market, they usually tend to buy, although not all the time, and that tends to hold a price. So as we close the week, very active trade this week, very wide swings, and we may see more of the same next week.
That was Tom Puckett, commodity broker at KS Futures, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Please join us Monday morning for your latest news update right here on ForexTV.com. Have a great weekend.